Hey everyone, and welcome back to the Gold Talk Show. Today on the channel, we're diving into, a really interesting turn of events we've seen recently in the gold market. You shared some great analysis looking at that pretty significant drop in gold prices, the one that occurred in late April and early May of 2025.
That's right. Yeah, we watched gold climb to a new all-time high, right? Around $3,500 per ounce. And then almost as quickly as it got there, it pulled back quite sharply, dipping below $3,300 per ounce.
Wow, yeah.
It was a rapid correction after, a sustained period of gains that had been driven by, things we all know, geopolitical jitters, those ongoing worries about inflation, and significant buying from central banks.
Absolutely. So for you watching today, our goal is to really understand what happened under the hood there. What were the key factors that sort of combined to cause this sudden shift? We're going to explore how macroeconomic data, developments on the geopolitical stage, specifically that US-China trade situation, the actions and signals coming from the US Federal Reserve, the strength of the US dollar, and even the influence of alternative assets like Bitcoin, how they all played a part.
Okay, let's unpack this and try to figure out what really drove this significant market move.
Okay, let's do it. So maybe starting with the timeline, just to paint the picture. Gold reached its peak around April 22nd and 23rd of 2025, like you said, right around that $3,500 level.
Mm-hmm.
Then we observed a rapid decline, with prices falling to just above $3,200 per ounce by May 1st. And this move included what was reported as the largest single-day drop in gold prices in several years.
Really? Wow.
Yeah, and from a technical analysis perspective, we also saw some patterns forming near that peak that, they often suggest a change in trend is coming.
Which is always something market watchers pay close attention to, right? Those little hints that the direction might be about to change. Now, as this drop was unfolding, the macroeconomic data that was coming out seemed a little contradictory, wouldn't you say?
A bit mixed, yeah. Let's start with the US GDP. We saw an unexpected contraction in the first quarter of 2025, down 0.3% annualized, when the expectation was actually for a 0.4% increase. Now, typically, you might think that kind of news, a shrinking economy, would actually make gold more attractive, safe haven appeal, but that didn't seem to be the dominant reaction. Why not?
Yeah, that's what's fascinating here, isn't it? How the market's focus can shift in the short term. I mean, while weaker GDP figures can often lead investors to seek out safer assets like gold, due to increased uncertainty about growth, the overriding sentiment at that particular time seemed much more focused on the unfolding developments in US-China trade relations and the strengthening US dollar. These factors really seem to overshadow the concerns that might have, typically arisen from a contracting GDP. This episode really highlights how specific narratives can grab hold and just dominate market reactions, at least, in the short run.
That makes sense. It's like the market had its eyes glued to a different screen for a moment there. And at the same time, we were still seeing inflation that just didn't want to go away, right? The GDP price index actually surged to 3.7%. So given gold's often seen as an inflation hedge, why wasn't that the primary factor keeping gold prices up?
Well, those longer-term inflation concerns certainly provided, a significant underpinning for gold's earlier rally to those record highs, no doubt about that. But in this particular short-term correction, the more immediate triggers were just different. The sharp decline in gold prices really aligned more closely with the emerging positive news flow around potential easing of trade tensions and that noticeable strengthening of the US dollar. Didn't really align with the sudden shift in the inflation outlook.
Okay.
It suggests that while inflation is definitely a key fundamental driver for gold over time, shorter-term price movements can be much more sensitive to shifts in, geopolitical risk and currency valuations.
Okay, so we've got this picture of unexpectedly weak economic growth data alongside persistent inflation. What about the labor market? We saw the March JOLTS report indicating a decrease in job openings, and this led to rising expectations that the Fed might start cutting rates. Wouldn't lower rates typically be a tailwind for gold?
You're absolutely right. They usually are. A cooling labor market often does lead to increased speculation about the Fed lowering interest rates. And lower rates generally reduce what we call the opportunity cost of holding non-yielding assets like gold, because you're not missing out on interest from bonds, for example.
Right.
And they can also put downward pressure on the dollar, both of which could typically support gold prices. However, once again, in this specific instance, those potential positive effects for gold just appeared to be outweighed by the negative influences we've already discussed. The de-escalation of trade tensions and the stronger dollar.
So they just got swamped by the other news.
Pretty much. It's a good illustration of how multiple forces are always interacting in the market, and the relative strength can change quite quickly.
And to further paint this picture of a potentially slowing economy, we also had weak data coming out of the manufacturing sector too, didn't we?
Exactly. Yeah, both the ISM, the Institute for Supply Management's Manufacturing Index, and the S&P Global Manufacturing PMI were below that crucial 50 level.
Right, the contraction line.
That's the dividing line between expansion and contraction. So this just further corroborated the signals pointing towards a slowdown in overall economic activity. So you had this rather complex macroeconomic environment, indicators of weak growth, but also persistent inflationary pressures. And the market, in the short term, just seemed to be giving more weight to the trade and currency narratives.
Okay, so let's really dig down into that trade situation then. You mentioned that escalating US-China trade tensions in early April had been a big factor pushing gold to its peak, the safe haven rush. What was the catalyst for the shift we saw in late April? What actually changed?
Well, what's particularly interesting here is just the speed at which the prevailing narrative seemed to flip. It was fast. In late April, we started to see reports suggesting the Trump administration had initiated contact with China to explore resuming trade discussions.
Well, okay.
There were also announcements about potentially easing tariffs on automobiles. And even President Trump himself mentioned the possibility of substantially reduced tariffs on Chinese goods, although, he did add the caveat, it depends on China's actions.
Right. Always a caveat.
Always. We also heard more optimistic rhetoric from the Treasury Secretary. And there were even signs China was considering offering some tariff exemptions for U.S. goods.
That definitely sounds like a notable change in tone, a real shift. So how did the global financial markets react to this wave of positive news on trade?
The reaction across global financial markets was quite immediate and pronounced. We generally saw an uptick in optimism. A tangible risk-on sentiment really took hold among investors. The hopes for a potential resolution, or at least a significant de-escalation of the trade dispute, really helped bolster investor confidence and appetite for riskier assets.
And that increased optimism, that risk-on feeling, that's what diminished gold's safe haven appeal, wasn't it?
Precisely. Yeah, as the immediate fear of a full-blown, damaging trade war receded, the demand for gold as that classic port in a storm, well, it diminished quite considerably. The heightened geopolitical uncertainty that had been a key pillar supporting those high gold prices began to dissipate, and that directly contributed to the sharp price correction we saw.
Makes sense.
It truly highlights just how acutely sensitive gold can be to both the perception of and the anticipated trajectory of geopolitical risk.
Absolutely. It's like the market collectively breathed a sigh of relief about trade, and suddenly gold wasn't quite the essential asset it felt like just a week or two before. Now, let's shift our attention to the Federal Reserve. We saw the minutes from the FOMC meeting released April 9th, but as you pointed out, their direct influence on the late April price decline was probably limited due to the time lag.
Right, a bit dated by then.
Exactly. But what about the actual speeches and public statements from various Fed officials in late April? What signals were they sending?
Yeah, we heard from quite a few Fed policymakers during that period. Powell, Waller, Kugler, Jefferson, Barr, Logan, Goolsby, the usual suspects. And against the backdrop of that weaker economic data we touched on, the GDP contraction, signs of a cooling labor market, the market really started to ramp up its expectations for the Fed to pivot and start lowering interest rates.
Right.
Some analysts even began suggesting the first rate cut could come as early as June, with a significant number of rate cuts, maybe 4, being priced into market expectations for the rest of 2025.
So again, the general thinking is lower interest rates tend to be good for gold. Why didn't we see that traditional support kick in here?
Yeah, this is where the interplay of different market forces becomes really apparent, isn't it? While those expectations of future rate cuts were indeed building, they just seem to be overshadowed by the more immediate and, frankly, more powerful negative influences of those easing U.S.-China trade tensions and the strengthening U.S. dollar.
Okay.
It's also quite possible that some of the investment capital that might have typically flowed into gold anticipating rate cuts was instead being drawn towards other assets, like Bitcoin, which, as we'll get into, was having a major rally at the same time.
Ah, interesting point.
And the Fed's own communication during this period, which generally remained cautious and data dependent, likely also played a role in tempering any strong positive reaction in gold that might have just been driven by rate cut speculation alone.
And we can't forget that fundamental concept of opportunity cost, right? Holding gold gives you no yield. So when rates are higher, gold looks less attractive compared to bonds, for example. Conversely, the expectation of lower rates should, in theory, reduce that opportunity cost and make gold relatively more appealing.
Exactly right. But as we've observed here, the influence of those other dominant factors, the improved trade outlook and the dollar's strength, just proved to be the more significant drivers of gold's price action during this particular stretch.
Okay, let's delve deeper into that resurgence of the US dollar then. You mentioned it experienced a notable appreciation in late April 2025. What were the main factors fueling that strength?
Yeah, the US dollar index, the DXY, which basically measures the dollar against a basket of other major currencies, kind of a barometer for its global standing, it did indeed see a significant upward move in late April. It reached a two-week high near that 99.75 level around the beginning of May. And as we know, there's generally an inverse relationship between the dollar and gold prices. A stronger dollar makes gold, which is usually priced in dollars, more expensive for buyers using other currencies.
Right, simple math.
Simple math. This increased cost can then lead to lower demand and consequently downward pressure on gold prices. And in this particular situation, that well-established inverse correlation was, well, it was quite evident. The dollar's rise really mirrored gold's fall from that $3,500 peak.
So what were the underlying fundamental reasons pushing the dollar up during that period?
Well, several factors likely played a role. Firstly, those very hopes for a trade breakthrough, the de-escalation of U.S.-China tensions, likely improved the overall economic outlook for the U.S. relative to some of its key trading partners. That increases demand for the dollar.
Okay.
Secondly, even though the US GDP data was weaker than expected, there might have been even greater concerns about the negative economic impact of trade disputes on those partner economies, making the dollar seem relatively more attractive, more stable.
A sort of cleanest dirty shirt argument.
Sort of, yeah. Thirdly, while the market was pricing in future Fed rate cuts, the Fed's actual policy stance at that moment was unchanged, and their communication was fairly cautious, as we said. That might have prevented a sharper dollar weakening. And finally, there were likely some technical trading factors at play, too. The DXY might have found support at certain levels and just bounced.
You even included a table in your analysis, I recall, that visually showed that inverse correlation between gold's closing price and the DXY's closing value during that specific time. It really laid it out clearly.
Yes, exactly. That table helps illustrate the strength of that relationship during this specific market correction. While that inverse correlation isn't always perfect, not always one-to-one in the short term, it was undeniably a major factor influencing gold's price action in late April and early May 2025.
Now, this is where things get particularly interesting, I think. While gold was doing this falling back, we saw Bitcoin doing something quite different. It staged a pretty impressive rally during that same period, didn't it? Approaching $95,000 by the end of April?
Yeah, near 95,000.
Is there a connection here? Is Bitcoin maybe starting to chip away at gold's traditional role as, a safe haven or store of value?
That's certainly the multi-billion-dollar question, isn't it? Or maybe $1 trillion now. Look, the stark divergence in price action, gold down, Bitcoin way up, undeniably fueled that ongoing narrative. The potential competition between the two, the possibility of capital rotating from one to the other.
Right, digital gold.
We heard digital gold being used again with increasing frequency, yeah. And there was renewed discussion about a potential decoupling, where Bitcoin's price moves might become less correlated with traditional assets.
So what are some of the reasons why Bitcoin might have been rallying while gold was under pressure? Any theories?
Well, several potential explanations were put forward. Bitcoin might have just benefited from that overall improvement in risk appetite, triggered by the trade hopes and the expectation of future monetary easing by the Fed. Risk on helps Bitcoin too sometimes. There's also the argument that Bitcoin is increasingly seen by some investors as a hedge against potential future US dollar devaluation, the kind that could result from those anticipated Fed rate cuts.
Sort of front-running the devaluation?
Possibly, yeah. Hedging against that possibility.
And there's some pretty compelling data suggesting significant institutional money flowing into crypto around then, right?
Absolutely. Market reports indicated substantial inflows into digital asset investment strategies in the week ending April 25th. Huge numbers. The overwhelming majority of that capital, over $3 billion, I think specifically flowed into Bitcoin.
Wow.
And there was even commentary from market analysts suggesting, the possibility of investors reducing holdings in traditional gold ETFs and putting those funds into the newer Bitcoin ETFs. Now, it's crucial to remember correlation doesn't automatically equal causation. But the sheer size of those inflows happening right when gold was correcting certainly raises the possibility of some degree of capital rotation. We even saw the BTC x AU ratio Bitcoin price relative to gold price showing a significant breakout, which some analysts took as a technical sign of Bitcoin's increasing relative strength.
And your analysis also included a table, I think, clearly showing that divergence. Gold going down, Bitcoin going up, or sideways high during that period.
Exactly. That table really highlighted their different responses to the same set of market conditions. Gold clearly trending down, Bitcoin either maintaining strong upward momentum or stabilizing high. Very different reactions.
So when we try to synthesize all of this, pull it all together, it really sounds like the gold price correction we saw wasn't just one thing. It was several interconnected factors all hitting at roughly the same time.
Precisely. Yeah, it wasn't attributable to just one single event or data point. That would make sense. The easing US-China trade tensions definitely reduced safe haven demand for gold and at the same time boosted the US dollar. That combination was a big headwind.
Right. Double whammy.
A double whammy, exactly. And while the weaker economic data did boost expectations for Fed rate cuts, which normally might help gold, that potential positive was just overshadowed by the more immediate, powerful negative. The trade de-escalation and the strong dollar. And we also can't overlook technicals. Gold was looking overbought by some measures, and those reversal patterns near the peak suggested it was vulnerable to a pullback anyway.
Setting the stage.
Setting the stage. And finally, you add in that emerging possibility of some capital shifting from gold to Bitcoin. It just added another layer of complexity to the whole dynamic.
So if you had to really pin it down, identify the most significant triggers that actually kicked off this correction in gold prices, what would your assessment be?
In this specific instance, I'd have to say the shift in geopolitical sentiment, those growing hopes for easing US-China trade tensions and the subsequent strong appreciation of the US dollar really appear to have been the primary catalysts. Those are the big ones.
It's such a powerful reminder, isn't it? That even well-established safe haven assets like gold are constantly being influenced by a really broad spectrum of factors in this complex global financial market. And the continued emergence and, well, increasing adoption of alternative assets like Bitcoin are just adding another layer of intrigue and complexity to the whole picture for investors.
Absolutely. And it really underscores that important point. While certain correlations, like the inverse relationship between gold and the dollar, can be generally reliable over time, they are by no means absolute. They can certainly be overridden by dominant market themes, shifting narratives, unexpected events in any given period. You have to watch everything.
So, as you've hopefully seen in this deep dive today, that recent dip in gold prices was a multifaceted event. It was driven by a real combination of forces, most notably, it seems, the shifting dynamics of geopolitical risk and the resurgence of the US dollar. It really highlights that even time-tested safe havens like gold are subject to this wide array of influences in the global market, and the ongoing evolution of alternatives like Bitcoin only adds to the fascinating complexity. We sincerely hope this detailed analysis has provided you, watching today, with a much clearer understanding of the significant market movement. If you found this deep dive insightful, please do remember to like this video, share it with anyone who might find it interesting, and definitely subscribe to the Gold Talk Show right here on the channel for all the latest news and in-depth discussions about the world of gold. Stay informed, stay curious, and we'll see you next time.